Okay, good morning, everyone, and welcome to this morning's edition of the Coffee Microcaps Morning Meeting. You're all very welcome. My name is Mark Tobin for anybody who is joining us for the first time, and I am the founder of Coffee Microcaps. You're all very welcome here this morning. Just a couple of quick intro slides and admin slides, and then we're going to get straight into it with our first presenter this morning. I would like to give a shout out to RAS Research as a Service, who are our virtual event sponsor here, Coffee Microcaps. If you're looking for some institutional grade research on some smaller microcap names that you probably won't get from any of the brokers around the market, please do check out their website for a whole plethora of reports that are up there on some interesting microcap names. I would also like to welcome our good friends from ASIC. If anybody is joining us this morning, you're very welcome. For anybody who is joining us for the first time, companies we generally have presenting on here, we have something kind of every second week normally, capped under 300 million in revenue, generally approaching cash flow break even, or indeed, as some of the companies are here this morning, already profitable. We tend not to have too many names from the resources and biotech sectors, what I like to call industrial microcaps, which covers everything else from financial services to healthcare, technology, hardcore industrial businesses, professional services businesses, kind of anything that doesn't normally drop into resource or biotech. Structured this morning's webinar, we've got three companies with us this morning. Each will present for 30 minutes, which we'll break down into a 20-minute preso, 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate the questions when we get to them. Please note that this webinar is being recorded and it'll be up on the Coffee Microcaps YouTube channel on Monday morning. You can follow us pretty much on all the socials. Twitter is our main one. YouTube, as I say, for recording of this webinar and indeed all our other events. We've done well over 100 of these now, so there's plus minus 250 microcap presentations up there now. LinkedIn, and I do write a free monthly newsletter, which will also be coming out on Monday, and details of our event, which will be happening Thursday next week rather than Friday. Our first company this morning will be Control Bionics. I'm delighted to welcome Jeremy Steele. This will be Control Bionics' first time on Coffee Microcaps, so I'm very interested to hear the story firsthand. Then at 10 a.m., we're welcoming back Gregg Taylor from Salterburg's Emerging Companies LIC. For anybody who joined our Microcap Manager Roundtable about 2 weeks ago, we decided to get Gregg back in, given there was a lot of questions around some of the stocks he was talking about there. And finally, welcoming back Gratifii, Iain Dunstan, CEO and MD, who'll be coming back in to give us an update on everything GTI. So I am going to stop sharing my screen, and Jeremy, if you want to start sharing your presentation, I'll let you know when I can see it coming through. Yeah, it's just loading now. Yeah, I can see the cover slide of your presentation now, Jeremy. You can take it away whenever you're ready.
Great. Thanks, Mark. Thank you, everyone, for joining this morning. I'm here, as Mark said, to talk about Control Bionics, which is a next-generation assistive technology and data measurement business, has been listed on the ASX for a number of years. And for those who are not familiar with the business, I look forward to introducing you to what we do and what we're going to do, more importantly. So perhaps just to introduce the business and to give you the headline of what I'm going to talk about today. Our technology was developed almost 20 years ago and really commercialized over the last 5 or 10 years. We are what I would consider to be certainly world first, but best in class proprietary technology, in particular in the field of electromyography, or EMG, as the acronym is called. We've as I said, the technology was developed 20 years ago, and as such, we've got a very good suite of regulatory clearance and intellectual property protection across the world. Our core business continues to grow organically. Our major markets are Australia and the US. And since I joined the business just under 2 years ago, we've been moving to diversify the way in which we generate our revenue and the markets in which our technology is used. And that's really the focus of our business moving forward. And I'll talk about those over the coming slides. Our core intellectual property is the NeuroNode. You can see how that technology has developed over the past 15 or 20 years. The neuroeducator you can see on the left, that technology was actually perfected with Stephen Hawking, who many people know. He was perhaps a beta customer, and Peter Ford, who founded the business, worked with him directly for many years to continue to perfect the technology. And as you can see through the three photos, as technology has developed, so has our proprietary technology. So the NeuroNode is the device that we've been selling into around the world for a number of years now, is in that middle photo, and the NeuroStrip is the next generation of our technology, which we're currently commercializing. Oh, excuse me. Let me just explain. I'll put on a video which will explain how EMG technology works for us.
At the heart of the Control Bionics product line is the NeuroNode 3.0, the latest generation of the world's leading wearable control device. The NeuroNode 3.0 connects to the user's communication device via Bluetooth and is attached to the user with the non-adhesive NeuroBand, or a clinical-grade non-invasive electrode. The NeuroNode 3.0 has two built-in methods for access and activation of the user's communication device: EMG control or spatial control. When using EMG control, the NeuroNode 3.0 reads the signal associated with the activation of a muscle group from the surface of the user's skin. The NeuroNode 3.0 can be placed externally anywhere on the user's body. Two common placements are the forehead for eyebrow raise and the arm for finger and wrist flexion. The advantage of the EMG mode is that the device is advanced enough to read minor movements, or in some cases, just the intent of a movement. When using spatial control, the NeuroNode 3.0 maps its place in space, allowing the user to associate specific movement patterns to actions and activations on their communication device. The advantage of spatial control is that it allows the device to be placed over clothing and is not dependent on a specific muscle movement. Whether using EMG or spatial control, the user's activation settings are quickly and easily customized through the NeuroNode controller application that is pre-installed on their communication device. Settings in this application can accentuate intentional movement and filter out what is unintentional, making it a uniquely customizable solution for users with tremors or fasciculation. To learn more about the NeuroNode 3.0 or to schedule a demonstration with your local representative.
So hopefully that is a good introduction as to how our EMG technology is used in the assistive technology space. This, I guess, is a pictorial example of how that works, but effectively EMG is the measurement or the detection and measurement of electrical activity in your muscles. So to move your finger, you have a thought to move your finger. In order for your finger to actually move, you need to generate an electrical signal, and the muscle contracts because that is an electrical signal. So we're able to detect the minutest level of activity in your muscles, and so in many instances we can detect activity even when you can't visibly see movement of a muscle. And that technology, EMG is a scientific term. It's used in a whole variety of medical diagnosis and treatment activities, and really how we diversify our use of technology of the EMG technology is really what we're focused in on as the business continues to grow and develop. So just a few minutes now on the markets that we operate in. So assistive communication is really what I've just been talking about and what the video showed, which is using our technology for individuals who are unable to verbally communicate or consistently verbally communicate. Assistive mobility is our autonomous wheelchair module called Drove, which we launched last year and now have TGA approval. And then data measurement is the extension of our existing intellectual property of the NeuroNode into new markets. And I'll talk about each of those briefly as we move forward. So the NeuroNode, as I said, our core intellectual property, we have patents across this, both our hardware and software, that in many instances run for many, many years, I think up to 17 years for a key feature of our software. That market for us, just in the assistive technology space, is really over $1 billion. It's a very significant market that's largely underserved for many reasons. But I think the important part for us is that there isn't a competing product for the NeuroNode, largely because of the quality of our intellectual property. And so, the best way to understand the opportunity for us is to think about, we currently have a retail sales team in Australia and the US. Those markets both have very good funding available, and you can see on the right-hand side, we recently received what's called a HCPCS code in the US. So in an Australian context, you consider that to be a Medicare rebate effectively. And so the US government will now fund $4,300 specifically, US dollars, I should say, specifically for any individual who needs a NeuroNode. That's a significant win for us. I mean, I can't understate, or I can't overstate, I should say, perhaps the size of that opportunity for us. And so we're working very hard, both in the US, but also now in Europe, to extend NeuroNode-only direct sales into third-party distributors. And that will be a key feature of our growth in the coming months and years with that new recent HCPCS code. And then you can see the second recent win, we've signed up Smartbox UK to be a distributor for us in the UK. Smartbox has about 70% market share. It also has the largest distributor in Germany as well. So there's quite some significant opportunity for us to grow into this market, and we're working hard to deliver on that in commencing in FY25. Drove, this is a world first product developed in partnership with Deakin University, which is to allow individuals who are unable to control or consistently control their powered wheelchair independent mobility inside their home. Really exciting product, meaningful impact to individuals who currently don't have any ability to control their wheelchair, can now choose a room and a location where they want to be. That is TGA approved as of the middle of this year. We're also working on our FDA approval, which is well underway. The ALS Association, which is MND, as it's called in the US, they provided us with just over $500,000 grant to assist us in our FDA application, and we should be announcing our US clinical trial partner in the coming weeks. I want to talk now about the NeuroStrip, which is our newest technology, and this video should give you a good example of exactly where we're going with this.
Since 2005, Control Bionics have been improving people's lives by changing the way we interface with technology through electromyography. Introducing the NeuroStrip by Control Bionics, the universal machine for physiology, 20 years in the making. The NeuroStrip brings an unprecedented flexibility and accuracy to EMG devices. Unlike other devices that are restricted to a wrist or connected to external electrodes, the NeuroStrip weighs only 3 grams, is as easy to apply as a Band-Aid, and can be placed at almost any point on the body. It is so sensitive that it can detect signals before there is even movement associated with the muscle contraction. The physiological signal is transferred through conductive segments of the electrode patch to the NeuroStrip electrode array. Measured in the mere millionths of a volt, the signal is transferred via best-in-class circuitry to 3 DSPs for multiprocessing. allowing high-fidelity real-time data to be transmitted wirelessly to the NeuroStrip app. The NeuroStrip's direct-to-skin, full-spectrum, and unrivaled fidelity output means it has universal application across a wide variety of fields, including rehabilitation, sports science, wearables, and medical industry. It gives voice and mobility to those without. It offers athletes unprecedented insights into their performance, allowing them to optimize training to improve muscle function and enhance their recovery. It facilitates more targeted, engaging, and effective rehabilitation treatments than ever before. It can provide the data to train AI models for the monitoring and diagnosis of medical conditions. It can even make work more productive and make play more fun. In fact, it's so easily integrated into other systems that all its applications are yet to be discovered. In an era that is transforming how humans interface with technology, the NeuroStrip is redefining how we connect, operate, and interact with intention.
So the NeuroStrip's a really exciting opportunity for us to, as I said, lean into our core skill set, which is surface EMG, and expand the way in which our technology is used, both in the medical field, but also the non-medical field. It really is a market, if you think about market size, it's very difficult to estimate how big this opportunity is because there is so many potential uses for surface EMG. We're tracking 16 individual or specific use cases for this. And obviously, given the size of our business, we're not going to do all of them and certainly not do all of them ourselves. And we're initially focusing on two areas that are really interesting for us. And the first is sports science and the second is rehab and biofeedback. I've been in the US and Japan over the last couple of months talking to partners, and we already have an existing relationship with a group called NeuroBounce in the States that run jump programs, jump training programs for sports people, particularly focused initially on basketball and volleyball. They use our technology, our EMG technology, to help athletes understand muscular activation to improve jump height. And they have quite extraordinary results. I mean, I think the best improvement in jump height they've got from an athlete that went through their 4-week program is to increase their jump height by just under 10 inches, which is quite extraordinary for someone who already is an athlete. So we will be talking more about this in our partnerships over the coming months, but this is a really exciting opportunity for us to diversify and grow our revenue. So just a little bit on financial performance. A flat FY24, a function of some challenges with the NDIS, which I'm delighted to say has certainly improved. We had what I believe to be a record first quarter in Australia, and October and November continue to be looking quite strong. So we're confident that our revenue growth will step back up to kind of north of 20% for FY25. We've been very disciplined on cost management and expect to keep costs flat 23 through to 25. You can see there the revenue split. About 80% of our business is in the US and 20% currently in Australia. Just a couple of minutes or a minute or so on how we get paid. So NDIS in Australia will fund these systems for individuals who are on those plans. And so obviously the primary funder in Australia. In the US, because we are FDA approved, we have the whole suite of people who fund us, and I think that the commencement of the HCPCS code, the new effectively Medicare code, from the 1st of October, we're already seeing a lift in our kind of like-for-like revenue on the back of increased access to funding through this new code. So what does the near-term focus look like? It's diversification of our revenue stream. We've been very much what I would consider to be a retailer. So with salespeople out selling systems to individuals, we're now looking to expand into what I would consider to be wholesale and partnership driven model. So the HCPCS code in the US is a good example. Smartbox in the UK is another example of where we're looking to work with partners who have existing sales teams and customers to sell our existing technology into them. And then with Drove, that will be a partner model where we should be announcing in due course our first distribution partner here in Australia, who will retail the Drove unit on our behalf. In terms of wins and future roadmap, as I said, I've been in the business since the beginning of last year. We refocused our strategy to narrow it down to some areas where we thought we could win and we could win quickly. I'm very pleased with how the business has delivered against its strategic plan. You can see there are a number of items we talked about over the last 12 months we've delivered on. In particular, Drove, the HCPCS code, the first European distribution partner. And then you can see over the course of the balance of FY25, there's a lot to do, but we're well advanced on all of these items, and in particular, NeuroNode only as a strategy is the near-term real opportunity for us, and you can see that already with our success in the UK. Great board. I would add, we've got a really experienced team. Shannon joined us recently as CFO, trained in the US, and but now permanently based in Australia. A high quality board. Peter, the founder, and Rob Hurd, I would also mention, who's a very seasoned and experienced neurologist. And James, who's the CTO, has been with the business really since its inception, and is the individual who really takes the lead in the development of our technology. I want to go to questions in a second, but just a little bit on funding. We raised some capital that completed in October, so well funded through FY25 and into FY26. A really supportive shareholder base, in particular Phoenix Development and Nightingale Partners were I think they were the first external money into this business many years ago and continue to be really supportive of the business. And maybe I just end there and open it up to questions.
Thanks, Jeremy. Maybe I might kick off with a couple of questions just in terms of just trying to understand the business model or the revenue model. Is it a hardware, software, style business? If you get in NeuroNode, do you guys make your money from actually selling the device to somebody who suffers from ALS like Professor Hawking, or is it actually make your money on the software to run it over the lifetime that they're using the device?
Yeah, look, I mean, there's the short answer is currently that core business is a hardware sale, not for want or lack of trying to make it. It's a more recurring type revenue, but it's very much a function of the way in which it gets funded. So both the US health system and the Australian health system don't want to pay ongoing fees. They want people to buy the equipment. So in the US, it is funded 100% upfront. In Australia, we've got a really good relationship with the NDIS, and I would say we're working with them to change, but both for the benefit of the health system and the individual. So rather than buy equipment that they may only need for a short period of time, because unfortunately many of these diseases are degenerative. So we've recently launched a leasing program in Australia, and so that equipment will stay with us and we'll lease it to customers for a short period of time. However, with the NeuroStrip, that is very much more building out a recurring revenue model. So for our first customer, NeuroBounce, there will be a hardware purchase, but there'll also be a software purchase, because obviously access to the data and how an athlete performs over a period of time and their muscular activation is the most relevant point. And so people will subscribe to access the NeuroStrip application.
Yeah. And then I know you listed off the countries that you've got regulatory approval, and the UK was one, but it wasn't really in the revenue chart there. It's a US centric slash Australia business. Is that because you haven't focused on it in terms of getting your own salespeople on the ground, or is it down to the NHS funding model, or why? If you have the regulatory approval, it hasn't really been a revenue driver.
Yeah, so I think this has come back to the development of the strategy that I put in place since I joined last year. The business, I guess, approached its view of commercialization by wanting to be solely responsible for selling. And when I joined, it was clear to me the opportunity was much bigger than that. And so to enter into a market like the UK, you've got a choice of either having your own salespeople or working with partners. And I took the view we should work with partners. Smartbox is a great organization. They have 70% of that market. We should get them to sell our technology rather than compete against them. So, nothing ever happens in business as quickly as I would like. And so, it took some time to make sure our software is in a position to be able to provide it to a third party. That was done last year. We signed Smartbox, a couple of months ago. And so that revenue from the UK, and indeed there's some other opportunities in continental Europe, will start hitting our books during the course of calendar 25. And so, I think the opportunity in Europe is significant, but one we've only just started working into. So it will become a feature of the business moving forward.
Okay. And in your node business, is it primarily for ALS patients, or does it, move across to people with Parkinson's, or what,
Yeah.
if I'm a neurologist, what kind of patients, am I recommending this to? And maybe just give us an idea of
Yeah.
the price point
Yeah.
as well.
Sure. So our customer base for the NeuroNode, or for, I guess, our suite of products, is split as follows. So there's about a quarter of our customers are individuals that have ALS or MND. A quarter is individuals who have cerebral palsy. And then the balance of 50% is really a collection of a whole number of conditions that, it could be stroke, it could be acquired brain injuries, if you've had an accident. There are other kind of neurodegenerative conditions that where individuals are unable to communicate but are cognitive. So, I think, I could speak for days about the ways in which our technology gets used. A really good example is Ryoka, who's one of our ambassador customers in Japan, where we have a small team. He has cerebral palsy. And the way in which that manifests is there's a lot of unintentional movement. So if you've seen an individual with CP, they can't control how their body moves. And so he uses the NeuroNode with electrodes on either side of his eye, and he's able to have intentional control over his eye. And so he communicates, and in fact communicates for the first time with his mother about 6 months ago through intentional movement. And how cognitive you are, or other people experience you, as a function of how you communicate. And if you can't speak, people don't know what's going on. So, his ability to communicate through using the NeuroNode is quite extraordinary. And that's really, the size of the opportunity for us is to go out and put this device into the market, because there is no other device like this anywhere in the world.
Okay. And price point for maybe talk, maybe NeuroNode and NeuroStrip as well.
Yeah, so NeuroNode, as I said, the US has just put a price on it of $4,300. In Australia, we can get up to 10,000 Australian dollars for it, but there's other ways in which it can be leased or provided to an individual. In Japan, the Japanese government will fund up to $3,000 for the device. The NeuroStrip will be much cheaper than that, to a large part because it's smaller technology. It's got a different use case. So a reusable NeuroStrip will be around the $500 mark.
And in terms of, other if we just talk about Drove, it's probably the least developed one. Is that Do you see you selling that to somebody who manufactures wheelchairs in the end, or is it very much going to be a partnership model where you've got the device and it seamlessly integrates with somebody's uh, electric wheelchair already?
Yeah.
Or
Yeah, look,
what's
I think
the
that's
long
definitely an
term maybe
opportunity.
plan for that device?
Yeah, so I think there's definitely an opportunity for us to partner, and whether that partnership means they take ownership of it and we, get a license fee, or, we create a joint venture. I think that's definitely an opportunity. I think pushing through the FDA approval will obviously, I mean, the US market is massive. We're currently at a conference up in Queensland. I was talking to the team yesterday. I mean, it's just the opportunity there is significant. I mean, we've had multiple people. We've got a system set up there at the moment, multiple people going through. And that price point in Australia will be about $14,500. As I said, whilst it is new, we expect to get the first sales through from that. Certainly in the next couple of months. There's a lot of interest there, and the interest in the US is just as strong as well.
Okay. And in terms of, breaking into other markets, I mean, you're already in quite a lot of places, Japan, Australia, the US, continental Europe. Is that the focus for the next 12 or 18 months? Or is there, are you looking at places, I'm thinking, Singapore, South Korea, uh,
Mm.
Latin America,
Yeah,
is it
yeah.
more, let's focus on the geographies we're in now, or there are plans to, kind of rapidly move out, given you're moving to the distributor model rather than trying to get your own sales team up and running?
Yeah, I think I'd like for us to deliver success in those kind of three geographies. I mean, continental Europe's massive, so I think Australia, US, continental Europe, and the UK is where we're going to put all of our time and attention. And not that we'll ignore other opportunities, but I think the risk of a business like ours is you try and do too many things and you're not successful in any of them. And so we're kind of laser-like focus on execution on the strategy that I've talked about today, and really pushing away any opportunity that can be a distraction from that. And that's not to say that we won't do other things, but let's get what we're doing right now done well, and then we'll focus on what next.
Okay, perfect. Jeremy, thanks very much for joining us. We're just up on time, and yeah, hopefully we can get you back in sometime in 2025 for an update.
I look forward to it. Thanks, everyone.
And we are now going to hand over to Gregg Taylor from Salter Brothers Emerging Companies LIC. Gregg, good morning.
Morning, Mark. How are you?
Good, good. For anybody who caught Gregg on our microcap fund manager round table, we had a lot of interest in that, so we said we'll get him back in here. Gregg, if you want to start sharing your slide deck, I'll let you know when I can see it coming up.
Excellent.
I should have enabled permissions for you. Yep, it's coming up now. Yeah, I can see the cover slide of the deck now. Gregg, you can take it away whenever you're ready.
All right, thank you. Good morning, everybody. Appreciate you taking the time. Just a little quick introduction on myself first, and then I'll talk about the Salter Brothers Emerging Companies Limited, which is a listed investment company under the code of SB2 on the ASX. But myself, Gregg Taylor, I'm Director of Equities at Salter Brothers. Been fortunate enough to spend the last 25 years as an institutional investor in Australian small caps, and very much a focus on microcaps during that time. I often reference was fortunate enough to work over 20 years ago with the team at Schroders. We had one of the first and only microcap focused Australian equity funds in the country. So it's great to have that perspective and experience as we go through various cycles and different macro considerations, and really shines a lot of light. As there's always a lot of volatility and uncertainty in this space, but it's great to be able to lean on that experience to work through that. So that's my background. I said spent a lot of time on both listed and unlisted equities in the small to micro cap space. I've actually sat on a number of ASX boards, from anywhere from a chairman through to head of audit and risk and non-executive director. So, and during my 25-year career, I took about a 5-year break from financial markets and started and ran my own business in digital media and content, and grew that to sort of 20 countries and 200 staff. And so again, a lot of different perspectives and experience sort of bring to the management of the Solder Brothers Emerging Companies Fund, and hopefully you see a bit of a reflection of that in the underlying. So I'm just going to try to move this page. Here we are in the presentation. So you've got your standard disclaimer there. Look, real briefly, conscious of the time that we have this morning, I'll provide a quick overview, touch on Solder Brothers as an institutional investment house, a little bit about the team, our process. I'll just reiterate our view on small and micro caps, why we are quite optimistic about where we are in the cycle and the 2 to 3 year outlook for small caps. Then I'll step into some of the metrics around the portfolio itself and recent performance, and then go into a number of the key holdings within the fund. So what I said, Solder Brothers, I joined Solder Brothers just shy of 3 years back. And it's truly an institutional fund manager, over $4 billion of assets under management, and they're split across property, credit, and equities. As I mentioned, I head up the equities business. What we're talking about today is the listed investment company SB2. And I guess just to really reiterate, we're dedicated player within the microcap space. The mandate for the fund is a under 500 mil market cap companies. So that's where we focus. And again, I've spoken a little bit about my background, but really fortunate to have a large and experienced team supporting me, which is critical in this sort of really deep diligence, active process we take with small cap investing. And we'll talk a little bit about the performance. The good thing is that a strong, the fund has over 3 years track record, and the performance has been quite strong of late, and we'll talk about that. But what we'll also talk about is the sort of anomaly of the discount in which SB2 trades to its underlying post-tax net tangible asset value. It's out to 34%, which is, I'll talk about the portfolio composition, but the vast majority of these assets are ASX listed companies where they're marked to market daily, and so that NTA value is real in every sense of the word. And there's an opportunity to access a diversified portfolio of what we believe is quality growth microcap companies on the ASX at a 34% discount to their underlying value, which is, again, pretty unique opportunity. Just talking a little bit about, I've touched on here about Solder Brothers, and I've sort of touched on the asset classes and the size, but I guess I can speak from direct experience in starting my own fund 10 years ago as a boutique fund manager, and versus the benefit of working with an institutional platform such as Solder Brothers. Where Solder Brothers has over 100 staff focused on operations, compliance, reporting, and all those important parts of managing other people's money. And what that enables the investment team to do, and myself, is spend the vast majority of our time on their portfolio. And I can speak firsthand as a co-founder of a boutique fund manager where we're managing $150 million again in this asset class. I was spending on average 50% of my time on the business of the fund manager, which only provided reduced time to spend on the underlying portfolio and the investments. And there's definitely a tangible impact of that. And again, it just gives you a little bit of a sign of the depth of the team here. Strong governance, and again, really deeply experienced across all the key aspects. Talk a little bit about the team here. I sort of touched on myself, but I'm based in Sydney, and with Francis down the bottom there, Frankie. We're based up in the Sydney office. Then we've got Tanae and Keegan, both very experienced as well, down in the Melbourne office. So, dedicated team of 4, really scouring over this market and looking for the best opportunities. I won't spend too much time on the process here, but it's basically, it's a very deep due diligence and discipline process that I've applied for over 20 years in investing in this space, and it's served me well. And it's all about detailed financial modelling, and we do build our own 3-way financial models on every company we review, and we review close to 100 of them. The portfolio's got about 25. They're the ones that come out with the best risk versus reward, but we do very deep cash flow, balance sheet analysis, as well as obviously the earnings and valuation work that we do. Always focus a lot on the qualitative aspects as well, and those qualitative specs, include things like the strength of management, industry dynamics, competitive environment, etc. So spend a lot of time out of the office, meeting companies, meeting competitors, and just getting a better understanding on the industries and companies in which we invest. I'll just touch on here, and it's probably been spoken about quite a bit over the last 6 months, but it's really starting to play out, and you'll see that in the recent performance numbers. But these valuation differentials are still very prevalent, and we've put out a couple of research papers which are available on our website, and I think been released to the ASX platform as well. But where we talk about relative valuations of the Australian small and micro cap market versus historic averages and versus their larger cap peers, and we're still seeing the largest discrepancy in over 20 years between the small cap and large cap valuations. And even over the last 12 months, we've seen improved performance in the small cap market, but that it's been pretty much in line with that of the large cap. So that gap hasn't really closed. Then we do a lot of work around what is the key driver of sentiment and small cap performance. Interest rates continually comes out on top, and as we're again all becoming pretty familiar with, US have already started their easing cycle on interest rates. I think you've also got the Australian markets, really the strong belief first quarter next year will follow suit. Overlay that with a little bit more certainty around the US political environment. I really feel we're in for a pretty positive period. Employment remains strong. Inflation feels like it's under control. Interest rates easing. Really believe that all the ingredients are there to drive sentiment and volume back into smaller micro caps. And I think for this whole audience, that's what we want to hear, and truly believe that we're seeing the green shoots of that. What I touch on here is just the performance of the fund, and this is the underlying asset performance. And we've had a pretty good 12 months. Funds up circa 35%, versus a small cap index up 25%. But then if you contrast that to the other key indices, there's not great differential in performance. So, smaller micros were agonizingly undervalued over the last 12 months. That gap's starting to close, but there's still, in our view, a very strong way to go. But what we're pleased with is not only we outperform the market by 9% over the last 12 months, we've done that consistently since inception, which is again over 3 years, which is a good reflection of the sort of the team and the process in which we undertake. Why I'm so optimistic and bullish at the moment is I've spoken about the top-down factors, and I really think we're about to move into the sweet spot of the cycle for smaller micro caps. And what this fund is a dedicated, professionally and actively managed and diversified portfolio of what we think are the highest quality growth focused small caps with very much a valuation focus. And over my time over the last 25 years, I'd get pretty excited if I'd find a single company that I could find that had revenue growth of circa 15-20%, had positive profitability, both at the EBITDA and the NPAT line, and trading on single-digit multiples. The exciting thing at where we are in the cycle now, and from the bottom up, which fundamentally I'm a bottom-up manager, is that we have been able to construct a portfolio of 25 holdings that, on the weighted average of that entire portfolio, represents those characteristics. And again, I speak about doing this for multiple decades. I can hand on my heart say I cannot recall a period in that time where I've been able to construct a portfolio with these metrics. So they're either the assumptions underlying them are terribly wrong, which history suggests they typically are not, or we really are in for we've been able to construct a nice portfolio here. And so what I've got here, you've got the metrics, but you've also got just a snapshot of the top holdings. I'll talk about a couple of the first and second top holdings shortly with dedicated slides. But I guess what's exciting for me is that I've shared this top 5 list for every month for the last 2.5 years, but especially over the last 6 months, there's 3 new entrants into that top 5, and that's always what we like to see. And they've been coming to the portfolio by displacing other companies that have performed well and may have been heading towards our valuation targets. We've lightened those positions and replaced them with newer, higher conviction holdings. So those, call it holding 3, 4, and 5, which those sort of companies in our top 5 represent 5 to 7% of the portfolio, so they're pretty high conviction bets. The first one there is Bluebet. So really intrigued about what's happening in the market at the moment in the sports and gaming sector. Obviously very topical at the moment with the Spring Carnival on. But what we've seen is a lot of consolidation, and we're very much of the view that there's further consolidation to come. You've seen Betr and Bluebet merge recently, and at that time we took a pretty meaningful position in Bluebet, which we've been building on. And look, there's a couple of others, ASX listed players out there that, in our view, is likely to be, involved in further consolidation. I think, and what we've seen with these consolidation is there's significant synergies to be had, and it's still a sector that's got great growth and opportunity. So our view on Bluebet is that it'll either be a recipient or a participant in further consolidation, and our view is that the opportunity for significant earnings growth and synergies resulting from that is really exciting. So there's one. The other one's a bit of an old favourite, EML Payments. It's funny, you see, when you spend enough time in this market, you see a lot of companies come and go through different stages. Not only does the market go through cycles, the companies do too. And Mark probably recalls EML Payments back when he and I were contemporaries on the buy side, 15 years ago. But I actually invested in EML Payments when I was at Schroders like 15 years ago, and it's a business that I've sort of known well and followed through the course of time, and Touchwood made a fair bit of money through multiple times. And sometimes you get on the right side of these equations, sometimes you don't. But EML's been very good to me during time. It's bounced between valuations of 50 cents and $5 over the last 10 years, and I've been fortunate to be on the right side of those cycles 3 times. This is my 4th crack at it. And so EML Payments, it's a now global payments business. Think gift cards, digital digital payments and very much global. What we like about it now is there's been a complete new management team and board put in place. We've actually had some positive experience with a number of those board members over the last decade or two in other companies. So we have a good relationship and trust in what they can do. And if you just look at the fundamentals, this business has done a pretty significant cost out and tidy up initiative over the last 12 months. And I think we're now moving into a bit more of the growth phase of that. And because it's probably still in the naughty corner for the underperformance from, a $2 share price down to a 50-cent share price over the last 3 years, there's not a lot of institutions holding this or looking at it yet. And we think it's a little bit underheld and about to move into a sweet spot. But more importantly, it's got the right people at the top, both at the executive and board level. And again, it's a really interesting space that we understand well. So EML payments. And then the things that I love about a team, and I'm not old, but the fifth holding there, PYC Therapies, is effectively a biotech, right? And I spoke to you probably 2 years ago, and over the last 15 years, I'd tell you that I don't really invest a lot in biotech because I just don't feel I have the domain knowledge and experience. And again, I just haven't been on the right side of previous investments made. And but I've got a couple of younger guys in the team who do understand the space, had more experience and knowledge, and really challenged me to consider sort of changing that view. And so I had set the hurdle really high for them and asked them to go out and scour the dozens of opportunities that all sound too good to be true, and said, let's just select two and let's make sure we can fundamentally value these businesses in the same way we value the rest of the businesses in our portfolio. And two came out of that, and they've been remarkably good for the portfolio. And so biotech was very much on the nose over the last 2 or 3 years. So the starting point was, again, out of favor, valuations very attractive, and there were some quality companies there. And so we did a lot of work. It was a 12-month project where we saw them all multiple times and deep work. And PYC was one that we backed. You'll see it's quite big now because we say we invest in companies under 500 million. It was well under 500 million when we invested in the business. It's only due to its strong share price performance, and more importantly, its operational performance, that it's grown beyond that. Our mandate allows us to continue to hold investments once they go beyond 500, as long as we start the position below that. And so that's what we've done. And PYC, really, really interesting company. And even though it's done well for us and more than doubled, this is one that could have a long way to go. And really good management, really good unique IP, and only on the start of a journey. So that's PYC. I'll sort of go through these a little bit quicker because I've spoke about them in the past, but they are our top two holdings. So, and again, I think we're all in this game, and when we play in smaller micro caps, everyone's hunting for the 10 bagger, the one that can increase 10x in value. And I'm sure the audience, there's been multiple people who have done that, and I've been fortunate to have a few over the times. But again, there's been some common characteristics about companies that I've been able to achieve those returns on. And I see this opportunity in AI media. So AI media, voice to text, live translation, again, global business. And it's a business that's, spoken to a 5-year target of getting to 150 million of revenue and 60 million of EBITDA. I've actually worked with a couple of, when I think of a handful of the companies that have had more than 10x returns, I worked with the management teams there about building out from the bottom up the earnings forecast and fundamentals independently to see if I can concur with their view of the opportunity. And in this case, we do. And the analysis that we share is that, or that I share here, is that in the event that they do hit their 5-year target, so the two others that gave 5-year targets and hit them was Technology One. I think I was one of the few and first institutional investors on that register 15 years ago. Another one called Altium, ALU, same case, first institutional investor on the register. And that they both followed this course. They had these fundamentals of big global thematics. So you had SaaS computing, you had connected devices. In this instance, you've got AI, artificial intelligence, or AI is everyone's catchphrases. And it also was a genuine global opportunity with strong management who are heavy investors in the company and got to the level of conviction in their momentum of their business to give these prescriptive longer term forecasts, and both of them have done that. And so again, AI Media, we held it at 30 cents. It's now at 80 cents, but I think it's got a long way to go. And the last one, which I don't think many people would know, and I know Mark's starting to do a little bit of work on, is a recently ASX listed company called Alfabs, AAL. And what effectively it does, again, listed in June of this year on the ASX, which is a feat in its own right. There hasn't been many successful listings for a long time. But it basically does engineering construction work as well as asset hire into the again, not too cool at the moment, but the coal sector up in the Hunter Valley. But this is a business again that's family owned, got very strong board, like the chairman's ex-CFO of Woolworths. You've got, some of the largest and most successful coal operators in Australia's history on the board and large investors in it. And, on our numbers, this thing trades at about a third of the value of its peers. And again, on our numbers, I think the fully franked dividend yield on this business, I think it's closer to 10%, and it trades on a PE of about 6 times. Really high quality, unknown, not well held company that I think it's won some pretty significant contracts that underpin its earnings for the next few years. And I think it's going to become a lot more known in the market in the coming 12 months. So the last thing I'll leave you with, I just spoke about this NTA discount. So 34%. So the underlying asset value is $1.07 of the portfolio. That's just the accumulation of all the underlying holdings. And you can buy that portfolio for 70 cents today. It's a 34% discount. Or if you flip it the other way, the upside from here is north of 60%, just in that gap closing. You might say LICs often trade at a discount to NTA, and that's true, but the average discount's around 5 to 10%, not 35%. There is a reason for that. We've had some unnatural sellers on the register, which we've largely cleaned out now. And when I say that, they were foreign investors via the SIV visa scheme that, backed by the government, were forced to invest into emerging company funds. And then after 5 years, they can sell those. And so what we saw is a few of those exit the register and create more selling than buying, hence the share price was depressed. Now, again, we've largely worked through that. Performance has been very strong, but in addition to that, we have a buyback in place, and we've been quite active in that. We've bought about 5 million shares over the recent period with that buyback, and it's just on pause at the moment because we've got our AGM coming up later this month. And another thing that just to leave on is the dividend or distribution of the fund. Historically, we have yet to have paid a dividend, but what we've committed to is at this upcoming AGM to provide an update on that dividend policy with a view of moving towards dividend paying in the very near term. So I think that'll be another positive catalyst and really tick all the boxes. And what we haven't done a lot of marketing, and through forums such as this one that Mark's done a great job with Coffee Microcaps, we're starting to get out and raise the awareness. I think with all those factors, we're really confident we can get that discount down and overlay that with some strong underlying performance. We think, really interesting risk versus reward exposure to, again, a diversified and professionally managed portfolio of smaller microcaps. I will stop there, Mark. I think I'm on time, but left couple of minutes for questions.
Yeah, thanks, Greg. We've known each other for a long time now, and as I used to work with Wilson Asset Management, one of the things, we had there when we, working in another LIC focus manager is, and I don't think you really touched on it, but I would like to get your thoughts on, obviously with a closed-end vehicle, you don't have to worry about redemptions in a market like this, and but the flip side is you don't get the flows in a good market, but just balancing the equity versus cash allocation within the portfolio, because you're never really a forced buyer or a forced seller. So, I can remember times when we were at Wilson's and we could be 40% cash, which you would never really get in a managed fund environment. So maybe just talk to us on how you balance, being fully invested versus keeping, cash to pull the trigger on, new opportunities.
Yeah, no, great question. And so we typically hold what we say we can hold up to 20% cash in the fund is the mandate limit. And there has been periods of time where we have had definitely over 10% cash in the fund. At the moment, we're at about 3 to 4% cash, are pretty fully invested. And that's because of our conviction in the market and the underlying holdings in the portfolio. But also, we're using all excess cash over and above that amount to use in the buyback because we know and believe in the underlying asset value of this fund, and to be able to buy assets which we'd buy at a dollar face value, we can buy them at a 34% discount. So the buyback is using the cash as well because we're pretty, in our view, a pretty low risk 30 or 60% plus return off that 34% discount. So pretty fully invested. What we do is we typically hold about 10 to 20% of the portfolio in what we'd call highly liquid small cap names, which we can get in and out of pretty quickly. So in the event that new opportunities present, we have what we consider as funding sources that we'd be able to raise 5% of the fund pretty quickly to deploy to any opportunistic things we see in the market.
And I'm going to ask one final one quickly as it's sort of related to that last point. Position sizing. So, your top five there, and you said you're pretty much fully invested with kind of 25 names. But in terms of, how much that top five would make up of, the full NTA.
Yeah, so we hold anywhere between 2 and 10% is the range of holdings. And again, the math of 25 holdings at 100%, the average is about 4. Transparently, the AI media is up around that 8 to 10% at the moment. And then those other top 5 are in that sort of 4 to 6 range. And so what you've got there is probably a third of the portfolio, 30% of the portfolio in those top 5 names. So it is a high conviction portfolio and quite concentrated, but rightly or wrong, that's how I've always invested. And now we do a lot of work to get to that conviction, and and that's hopefully what will continue to drive performance going forward.
All right. Greg, thank you very much for joining us once again. And we'll maybe get you back in early in 2025, maybe after results season, and see how a lot of these names have reported.
Absolutely. Appreciate the opportunity, and thank you everyone for your time.
Thanks, Greg. And we're going to hand over now. Greg, if you could, stop sharing. We'll hand over to our final presenter of the morning. I'm delighted to welcome back Iain Dunstan from Gratifii. Iain, good morning.
Yeah.
There we go. Oh. And you're back on mute, Iain, if you just want to take yourself back.
Why is it doing that?
No, there you
Okay.
go. Yes.
Good morning.
Morning. If you want to share your presentation, Iain, I'll let you know when I can see it coming through.
Where is that?
So the share button should be on that bottom nav bar. And then you should be able to select it.
There
Yeah,
we go.
it's coming
Got it.
now. Still just loading. Just wait for a second. Yeah, you're on the disclaimer slide now. If you just want to go to slideshow mode in, it should pull it up into a slightly bit bigger for us. So if you look across the ribbon there, it's the 1, 2, 3, 4, 5, 6 ones.
Trying to get it.
Yeah, if you hit that, we should have you on full screen.
Have you got it?
Not yet, but it's. I think it's pretty clear. We can go ahead as is, Iain.
Okay. Hopefully it changes soon. Yeah, good morning. Gratifii is one of the largest suppliers of incentive, reward, and loyalty programs and services in Australia and New Zealand. The company's grown in the last 3 years from about $2 million of revenue to about $85 million of revenue. The sector we work in, the incentive, rewards, and loyalty space, is probably one of the hottest spaces to be working in right now with cost of living. Yeah, everybody's looking for a discount, everybody's looking for rewards, and that's across pretty much every industry. Yeah, retail, hospitality, yeah, every industry really has and are looking to grow and expand their loyalty and reward programs. So it's been particularly good time for us over the last couple of years in terms of adding new clients, new programs, and growing the business. We have about 85 clients across the business, and the future looks particularly strong for us. This is really not working. So what we do, so not just we run loyalty engagement programs for large clients now, and in that we design the programs, we launch the programs, we do the tech, we do the marketing. We then also provide the rewards and incentives. So we source the best deals in market across anything from retail to travel to wellness, movie tickets, theme parks. We do a lot of experiences, things that customers want. And we tailor these programs for large corporates. Recently, the last couple of weeks, we've done a program for Coles. What they're going to launch on Black Friday is anyone that places an order of $50 or more online will get a free Hoyts movie ticket. And we put that program together for them for Black Friday. So that's the sort of customized offers that we do in market for large corporates. And as I said, we have about 85 large clients we work with. Then we sort of work up that chain to do brand and partner collaborations where they may be launching new brands and they want us to help promote those new brands with incentives and rewards. We also then flow through to their marketing and events side of the business. They might do launches. We can run all of this for them from start to finish. And we have our own technology platform, which all of this is loaded onto. And we can get clients up very quickly, in a matter of days or weeks, not 6 months or 12 months, depending on what it is. Very fast to market, very rich state-of-the-art technology, which is very attractive if you need to launch programs quickly. We're able to respond very quickly so that we can deliver those programs. Who we target, we have different types of target market. So we're particularly strong in the member type organizations. So that's, our biggest clients are RACV, NRMA, RACQ. but we also have super funds like Rest and other super funds, anyone that has memberships, health funds, HBF, things like that, where there's members, we put together member engagement programs for them. Then we have another target sector is customers. So people for us like Alinta Energy is one of our larger clients, where we will give rewards to their loyal clients or people that renew, or potentially a new consumer with a new house. We'll put a program together for them. We also do all the Wesfarmers clients, so Bunnings, Kmart, Target, we put together their rewards programs for them. As I said, Coles is a big customer for us. The third sector is employees, where companies will have employee recognition schemes. Our biggest client in this sector is Westpac. So all of the Westpac employees can go onto an internal portal and buy discounted goods from us. And then the final type of customer that we chase is what we call channel sales. So that's resellers, franchises, that sort of thing. So, our biggest in this space is NGK Spark Plugs, which is the biggest spark plug company in the world. We run programs for 5,000 independent mechanics. We run competitions for them. If they sell more NGK product than competing brands, we reward them, and then we'll take the top 20 salespeople to a private box at the Abu Dhabi Grand Prix to reward them. So, franchise businesses are the sort of fourth style of customer. So it's a very large marketplace with a lot of opportunity. And as I said, right now, discounts with cost of living and looking for savings is forefront of most organisations' mind. The business has recently as Monday, acquired one of our major competitors, a business called Club Connect, and a business in New Zealand to help us expand into New Zealand. As a consequence of these acquisitions, the unique thing about our business is we now have 23 million individual accounts on our software platforms, which allows companies to get amazing reach when launching new products or new things. Very few companies or organisations would have that many individual accounts on their system. Now, I'm not saying we have 23 million of Australia's 27 people, because a lot of people will be with Alinta Energy and bank with Westpac, might be HBF for health, and with RACB. So there's a lot of double up, but we have 23 million individual accounts, which gives us access to 70% of all Australian households and 60% of all New Zealand households. So we have this amazing reach that people want to access to distribute their products. Recently we've done a deal with Big Red Group, Red Balloon, to load up their 5,000 experiences and products to be able to distribute those to the 23 million accounts. And this is the sort of business that is coming our way. As I said previously, that these acquisitions now bring us to $84 million of revenue, and we are EBITDA positive. So the highlights, that leaves us at 3.2 million underlying EBITDA. And the beauty of this is now we have massive scale to be able to improve our margins, and makes us far, far more attractive to consumers. So we have a very, very strong pipeline at the moment of new opportunities, which we are working with to give them access to this market that we have. touching on Club Connect, the reason we acquired them is we had RAC in WA, RAA in Adelaide, and RACB in Victoria. They had RACQ and NRMA. So it was a natural acquisition to give us all of the motoring organisations. Now, the motoring organisations between them have just under 9 million members. That we added 5.6 million with RACQ and NRMA to our existing client base. So again, as I said, what we can now do across that group is we can standardise their marketing, add a whole lot more services to them, upsell, design programs, launch new products. It gives us a massive opportunity to grow the revenue base. We acquired a small business called Rapport in New Zealand, who has One New Zealand, which is the ex-Vodafone, and again, the Automobile Association in New Zealand, who already we're starting to work with on new opportunities. We see New Zealand as a market. We've only got a small number of clients over there at the moment, 3 or 4, that this is a beachhead to allow us to grow that market substantially. So great opportunity for us to become dominant in New Zealand as we are in Australia. If we look at our forward metrics that we provide to the market, you can see from this, our pro forma is over $84 million of revenue and an underlying EBITDA of about 3.1 million. This doesn't include, that's just as of the date of settlement. It doesn't include any new business over the next 12 months. We expect to substantially have greater revenue and margin than this starting point, looking at the pipeline that we've already got. So it's a great opportunity not just to grow horizontally through markets, but vertically in that more and more services that we provide to our existing client base. So, you probably see we have a market cap today of about 16 million with 84 million of revenue and over 3 million of EBITDA. We think we're not being looked at the way we should be. Here's just a sample of the household names that rely on us to do their rewards programs, their loyalty programs, their employee programs. And you can see it's a very broad range from financial services to retail, to member, to IT, to super funds, student groups, healthcare, motoring. We recently signed a deal, which I saw previously from Gregg with EML, which we see as a very big opportunity for us. We're supplying products to their 500,000 salary sacrifice customers. And that program's only been going for a couple of months, and already it's been very successful and looks like growing even further. So that's been a very, very good opportunity for us with EML, cross-selling our products between the two groups. So, we've spent the last few years putting a lot of work into getting a base for us to grow from substantially. So, we see 84 million of revenue as really just the starting point. We expect to do a lot better than that. As I said, we were the 3rd fastest growing company in Australia last year on the AFR list. We're fully certified for ISO 27001, which has been a big program we've undertaken, again, to ensure that we can deal with the volumes of revenue that we're dealing with. We put that into context. Our busiest period is over Christmas. We do very close to $500,000 revenue a day. with these products that we sell through the Christmas period, which is a strong period for us. So we have to ensure that we've done all the security, and that's a very big part of our business, particularly dealing with banks and the Coles and all the large organizations we deal with. Security is a very, very important part of what we do. And we are fully certified carbon neutral. We put a lot of work into that. It's not a greenwashing program, it's the full government program to ensure that, for our supply chain up and down, that we are certified carbon neutral. So we think we're in a very exciting part of the market. We really only just started touching on the surface. We can grow horizontally through market segments, and we can grow vertically by adding more and more services to the 85 enterprise clients we already have. And so it's a very exciting time. It's a very different company, because with the acquisitions, we've gone from 30 million revenue to $85 million of revenue. And companies are looking at us very differently now. It did take us a long time to put those acquisitions in place, but it really sets us up now for the future. As I said, we've got a market cap today of 16. I think we've got 4.5 million cash in the bank. And we continue to grow. So we think it's a great space and a great time for us. And we think the future looks really strong. No?
Thanks, Iain. We got a question in here already, so let me tackle that first one. Post these acquisitions, what is the competitive landscape, look for you now? Let's focus on Australia, because you say, the New Zealand business is, gives you a bit more scale there, but maybe just talk about the main business in Australia now that you've taken on Club Connect. Who are you still competing with?
Look, what we do differently to any of our competitors is we source all of our content direct. We don't buy through wholesalers. Most other people in this space buy through wholesalers. So we actually have a direct relationship with all of our customers, all of our suppliers, which allows us to get far, far better pricing than anyone who's got a middleman in the middle. And I think that's clearly evidenced by the recent deal we did with Coles, where we were over 30% cheaper than any other supplier in market. And Coles were just like blown away. They couldn't do a deal as well as we did. And they said, we do how we got that deal, which is a good story, is we do all the Coles employees rewards and incentive program. So for their 135,000 employees. And they were in a meeting with the digital team, and they said, we need to source some new content for our programs and promotions. We've got, Black Friday, Christmas, And, a couple of people in the room went, well, you should maybe talk to these guys, because they do our staff fund and we get some really good stuff from them. And they contacted us, and their digital team were just blown away by what we could do for them. They couldn't believe it. They'd get, where have you guys been all our life type thing. So, we see that Coles relationship just getting stronger and stronger and stronger. So in our space, we are the biggest by a long way in terms of individually sourced content.
And then maybe you mentioned Black Friday there, and obviously we're on the run into Christmas already. Seasonality between first half result and second half result, or Q1, Q2, 3, 4, is it very weighted to this first half, or given the broad
we have two
of enterprise clients you have, does it kind of even itself out, because obviously Linta Energy isn't very focused on the run into Christmas?
Look, we certainly on a monthly basis is very seasonal. Put into context, in both December and January, I would expect to do about $12 million of revenue. But February is a short month and everyone's back at work, is usually a very average month for us. So quarterly, you have December in one quarter and January is a different quarter, so that's good. Wherever school holidays fall, we'll do a lot more business. So generally, the second and fourth quarters are stronger than the first and fourth. But at the scale we're at now, that is not as pronounced as it used to be.
Okay. And then another question, maybe if we can just talk about New Zealand for a minute. Does this acquisition give you an opportunity to go back to some of your, bigger Australian clients and say, hey, we've now got a larger presence. You already operate over there. Maybe we couldn't service you as well before because, we didn't really have the scale in that market. Is that kind of conversation able to be opened up now with the Australian customers who have a New Zealand business, but you weren't really in a position to kind of come to the party for them before?
Yeah, I mean certainly that, but it's more the New Zealand customers don't like dealing with someone who's not in a market. Like, I don't believe you can enter a market remotely. If you don't have an office and people in country, I think you insult that country. And even though we had 4 or 5 customers over there, there was always, well, you don't start work till 10 o'clock. It's not ideal. So we are getting a lot more interest from New Zealand. And so the time was right to grab a company to give us a presence.
Okay.
But we expect New Zealand to grow quite substantially.
A couple from the audience here. One on the technology platform. We haven't really touched on that here in the questions yet. How does your technology platform compare to global providers such as Bionics, capital investment profile, maybe, how much you're investing to, enhance what you've got there currently?
Yeah. Look, I'll be biased, I'm certain, but from the feedback in the market that I have, we're substantially better than Bionics, substantially. I can't say too much on this, but our technology platform. Look, one of the points Timo says, we've recently hired as our CTO the ex-CTO from Qantas Money. So that's the quality of people that we've got coming into the organisation now. Now, he's only been here a couple of weeks and he's looked at our technology and gone, wow, it's unbelievable. Like, it's well built, it's functionally rich, it's got everything. He was blown away by the quality of our technology and what it can do. So that's someone coming in from Qantas Money, being extremely complimentary and actually quite surprised at how good our technology was.
Just a question maybe on the kind of revenue / business model, if that's the correct way to phrase it. But relationships with key customers. So let's whether it's Coles, Atlanta, RACV, NMRA.
Yeah.
Is there kind of a contract in place where you've got to deliver 2 or 3 programs or for them over the course of a year, or is it literally they want to do something end of financial year, run into Christmas, they call you and you deliver that project for them depending on how big or small it is?
Yeah. Look, I mean, there's no one size fits all. That's the beauty of the company. Some companies will do quarterly, some companies will do half year, some will just randomly have a product launch and come to us. Some are set and forget. The employee ones, we tend to, each month we'll talk to the HR manager and say, here's a special for the month. and we'll send out an EDM and promote that. We've just done a very good deal with Red Balloon, that we've got a gift card coming out this week for Black Friday and Christmas, where you get a free 20%. So if you buy a $100 gift card, we'll give you a $120 gift card, which is a pretty substantial uplift in a cash product. And that's a special that Red Balloon are doing for us. In fact, we did it directly with Naomi Simpson because we have 23 million people accounts we can distribute that to. So it's worth people's while. And, we're able with that scale to drive better than anybody else has in market deals. I mean, no one else will get 20% on a gift card from Red Balloon. No one. I don't think anyone even gets 10. So, that's the scale that we have and the buying power that we have.
Another question here on cash generation. Yeah, maybe just talk us through more broadly, the kind of working capital cash cycle of like how these products go from, conversation with the Coles digital team to, actually executing on the other end.
Yeah, again, that's variable. Sometimes it's one day. Sometimes it's 6 months. Depending what collateral you need to do about it. If it's just a product, we can load that up same day. If someone says, we want this product, can you, we did for an aged care provider, they bought $360,000 worth of gold class movie tickets from us. Now, we could do that same day. So, so we got those one-off sort of things, which we do a lot more coming into Christmas. People will ring up and go, oh, can we get $500,000 worth of this or whatever? So, and then you've got the ones where they're coming quarterly. And so you can work around that. The other beauty of the business is because our relationship is direct, we have APIs directly into most of our suppliers, so we don't have to carry a lot of stock. We will do some cash specials every now and again. Our content providers will say, if you buy $500,000 worth before the quarter end, we'll give you 30% off. So we do a bit like that. But again, we're so entrenched that most of our suppliers are on APIs now. So they go directly into their inventory to buy the goods.
And one final question, I know we're just up in time, but I want to squeeze it in. One of the slides that you had back in the deck, the four main kind of groups that you target was, employees, the membership-based organizations. In terms of, adding rapport and club connecting, it's that one, number 5. I mean, which one of those is the, kind of the biggest now, and will it still be the biggest post kind of club connect and rapport coming in?
A very good question. A very good question. Yeah, right now we are particularly strong in the members space because of the auto clubs, health clubs, super funds. But paradoxically, that's a smaller market than customers and employees. So it just goes to show, one of the questions is, you're at 85 million, how do you get to 150 million? Well, it's in this slide that of our 85 million, probably 50 million is in the member square at the moment. And yet customers and employees is a much, much, much bigger opportunity to grow into. So we are spoiled for choice as to where we can go and where we can grow. But historically, the members part at the moment is the larger part of our revenue. But the opportunities are most definitely in customers and employees.
Yeah, no, that's what I was saying. Is you're saying if you're managing, Coles, Employee Rewards at 135,000 members that are not members, part of their program that just rolls month to month to month to month.
Yes.
It's a you know, it's a lot more stable and you know, a lot more um attractive than, you know, members where, you know, they're pushing maybe two or three things in a
Yeah,
calendar year as opposed to something that's happening every single month and is, you know, proactively managed by the HR department.
yeah. So, yeah, on top of that, I can say the business has never lost a client, never lost a single client. Yeah, in the last 4 years, we haven't lost a client. Per member, Coles is our most engaged. They will spend more with us per member than any other company. So they're a particularly good customer for us.
Okay.
But yeah, they've been on the system, yeah, from prior to us, sort of 7, 8 years now. And it's a really good relationship. So yeah, we haven't lost any clients in 4 years.
Okay, perfect. Ian, we've gone slightly over time, and I don't want to take up any more of your morning. Thanks very much for joining us, and yeah, as I've said to our previous two guests, hopefully we can get you back at some stage in calendar year 25 to give us an update on the integration of the two new businesses and how everything is tracking.
Great. Thanks, Mark.
Thanks, Ian, and thanks everyone for joining us. And we will be back next Thursday morning. The invite should be going out Monday or Tuesday on the companies presenting next week. And I wish everybody a good rest of their Friday and a good weekend. Thank you.